Hey, what's going on, guys? Jeff Koga here, and happy New Year's. It's a 2013. It's January 2nd, and this is my first video blog for 2013. So thank you for y'all that's following along. Now, first off, I want to thank each and every one of you who's been following me for the last several years or so on all the videos that I've been coming out with the content. I hope you guys like it. I know we've been getting great comments and stuff like that, so thank you so much. But the reason why I'm making this video is I want to tell you a little story about a particular book that you see on the screen right now. It's called a book called The Trusted Advisor by David H. Master. And this particular book was given to me back in 2003 when I was 18 years old, straight out of high school, and when I was working in the financial service sector. And it was given to me by my boss at that time, and he said, Jeff, you need to understand the difference between a customer and a client. And I said, customer and a client, aren't they the same thing? And he began to explain to me that it really is not the same thing. And it goes on to break down that customer will actually purchase things or purchase a commodity or service versus a client will go ahead and take advice from another. So those two key differences and the choices of words that you use when you are trying to grow your real estate business make a world of a difference. And here's what I mean is several months ago I made a video blog on a concept called Thank You Investor. And Thank You Investor is something that I like to coin where you're truly out there looking to help and serve the investment community, right? There is no accident on why I make these videos. There is no accident on why I do Flippinese TV. There really isn't any, accident that I'm doing all this. It's all done purposefully. Why? Because I'm looking to serve the community for folks that want to learn how to get into the real estate business, folks that are interested in investing in real estate, actively or passively, or anyone who's just curious on how to make money in real estate. So, that's one of the reasons why I make these videos and hope that it can go ahead and have an impact on. But in that video, when I talked about the Thank You Investor, I talked about the biggest concept of a moral obligation, right? And that's where a lot of people, I think, have issues when it comes to the real estate investing in general. I think, we're in an industry where a lot of money gets exchanged, a lot of money is made, and a lot of money is lost. Yet, when we're in this particular industry, I've come to realize that there are less people who actually show gratitude of doing business and actually out there educating folks. And that's one of the reasons why we're doing all this stuff as an organization and me personally, because there is an absolute moral obligation for you to not only protect your clients, meaning that is it your investor, your private investors who are looking to grow their nest egg, who's looking to get some type of return, or who's looking to capitalize on the small window of opportunity, but you have a moral obligation to protect their capital, meaning that whatever it takes, you need to protect it so that way you can go ahead and minimize their losses. Now, obviously, there can't be any guarantees and so forth. Why? Because it's an investment, but you do have a moral obligation to protect them. And if it is out of their risk tolerance level, then you have a moral obligation not to push that particular investment. Now, I'm not a financial advisor in any means, but it was something that I did before real estate and so forth. So you do have a moral obligation. And this particular book, The Trusted Advisor, taught me all of that stuff and why you need to protect your investors. And I want to show you something that's very, very interesting that happened several months ago from a particular investor, and how I kind of explained to the folks where this particular investor was interested in investing with our organization and kind of told me some couple things on what they were looking to do. And long story short, I ended up responding back in a way where I hope that she saw benefit, and I hope that possibly we can do business later on in the future. But I have a moral obligation to tell the truth. So here's what happened. Okay, let me show you the exact email, right? So here's the actual email that I sent out, and it says, Thank you for taking the time to review our investor opportunity package and sharing your financial goals with me. Why? Because we send out to our private investors, we send out these packages to actually break down our deals and how our deals are put together, what type of returns, and so forth. And then I went on to explain, it says, the question you ask is a very simple yet complicated answer. So I'm going to apologize ahead of time since the email may be a tad bit long. Why a long explanation? I just want to make sure I can explain in the simplest form to this complex answer and give you some context of where my opinions are coming from. So I'm being totally upfront, being very honest, letting them know that, hey, it's going to be a long explanation, but hey, you know what? Let me at least tell you where I'm coming from, so that way at least you have some context on where I'm coming from. So I go on and says, before getting into real estate, I worked in the financial service sector and did many estate and financial planning for my clients. So I'll put on that hat and try my best to answer your question. You may not like what I tell you, but this is the best way I can answer your question of. And this goes back to, as I said, the difference between a customer and a client, right? A customer typically is a commodity and you're treating them as a customer, meaning that you're pounding sales, pounding them to say, hey, buy, 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 versus if it's a client, you have fiduciary responsibility to be open and honest and fair dealing, so that way you can protect their best interests. So I go on and says, and the question that she asked was, which scenario, if any, would you choose of the three investment opportunity you presented and why? So we had our packages and we sent out to our investor list and we had three investment opportunities that they can go ahead and invest on. So I went on to actually answer that question. And I said, when I first read your financial goal criteria of $2 million in 11 years with initial capital of $250,000. So that particular person had $250,000 to invest and they wanted to grow that capital, the liquid capital, from $250,000 to $2 million in 11 years. And why 11 years is because that's when she wanted to go ahead and retire, and she wanted to make sure that she has that capital preserved as $2 million liquid cash, so that way she can live comfortably, right? So I decided to put that data into a quick calculator to see what type of annualized return you would have to make to hit those goals. And below is the calculation. Keep in mind, this has no contribution of new capital during that 11 years. So what I used was basically the statistics of using 250,000 without putting any other capital into the actual growing fund and using a case scenario. So this is how it kind of looked like. So you can see right here at the top is for them to go ahead and grow $250,000 with to $2 million. In this case, in 11 years, I used 2.2 million. I went backwards. They needed to get a return of 20% annualized return each and every year. That's pre-tax dollars, okay? So depending on if you have it in a retirement account that's tax deferred or tax free, or do you have it in just a fund where you're going to get hit with short-term capital gains and so forth, right? Those are not calculated, but it had to be 20% that you get consistently for 11 years straight for them to go ahead and grow $250,000 to over $2 million. So that way that investor can retire, right? So that's the kind of chart that I explained to them, right? And I said, as you can see, in the 11 years, you would have to get an annualized return of 20% for 11 years straight to hit your goal. And I put important side note, this calculation does not calculate federal and state taxes. That is where you would need to speak to your financial advisor or CPA if you structure your investment nest egg correctly via using a self-directed Roth IRA. You can grow your retirement tax deferred and take withdrawals tax free. So those are key things that you need to know the difference. Tax deferred growth versus tax free, right? Huge difference, right? That you need to know. Now, I went on and said, now that we have at least a net percentage you will need to generate over the 11 years period, let's take a look at the realistic number on the propensity of having the average return of 20% by comparing it to the returns on something like the Dow Jones, right? When I explain things, I always like to go ahead and explain it where people can go ahead and have some type of comparison with something, right? Because if you don't have a baseline comparison where you can compare something with something else, then really that type of return really doesn't mean anything to anyone, right? It's just numbers, right? Unless you put some type of comparison. So I went on and says below is the Dow Jones historical trend over the last 100 years. And here's the actual figure. So it says in a secular bull market, meaning that it's taking off, right? The dot-com booms, right? All right, and so forth, right? It says, or an upward trending market occurs when each succession high point is higher than the previous one. So annualized returns on a secular bull market comes from 1896 to 1906, went from 9 years for a 10.56% return, cumulative return 148.92. Now annualized return from 1924 to 1929, right? As they call it, the rolling 20s, as they call it during that time before the Great Depression, was the 30% return, right? And that was only for 5 years. And then from 1954 to 1966, that's right after the during the World War II and stuff like that, 8.72%. And then from 1982 to 2000, which is considered to be the dot-com, the later half and so forth, right, was 15%. Annualized return. And then take a look on the secular bear market, right? From 1906, 1924 is 0.024%, 1929, 1954, the Great Depression, 0.07% annualized return. And from 1966, 1982, right, the stagflation era, as they call it, right, Paul Volcker era and so forth, right? And from the 2000 to the 2010, right? Even though, yes, we had a real estate boom, but the actual Dow market or the stock market was being effective. And that time it was less than 1%, 0.52. So that's what I explained to this particular investor. And I said, as you can see, the stock market has rewarded investors during the secular bull market, with the last boom being in the 90s during the dot-com boom with the annualized return of 15%, while during our last secular bear market, the annualized return is 0.52%. This includes a record high in the Dow Jones in late 2011, October, but please don't quote me on this, because I was just writing this pretty late, and with the crash of September 2008, only a year later. So meaning that it was a high, then it went down. The point of all this technical history and background is to explain to you that in any investment, you are driven by market forces, and those who invest in the right market at the right time with the right investment vehicle will make the highest return. And now, obviously, that's my opinion. Now, let's finally answer your initial question of which scenario, if any, would you choose the three investment opportunities you present and why? And I went on to say, based on the information you gave me and your financial goal, I would say that all three can hit your net return for your goal of 20% annualized, meaning that we were giving more than 20% annualized on a return. What I'm not comfortable in saying to you, and what you may be missing, is this. Expectation of 11 years at 20% is too long. We won't be able to sustain that type of annualized return for 11 years straight on this residential flip model. So I'm being totally honest, and why I humbly believe that we have 3 to 4 year window in this current real estate market. Think early mid 2005 real estate market. And I went on to say international investors are distorting the returns as the U.S. dollar has gone down in value in the last several years. With the euro crisis, we have seen more international currency flood the real estate market. This is one of the catalysts for the low inventory, since these international investors are okay with the 8 to 10% yield and are buying up properties, including the big Wall Street entering into the real estate market, right? I was already explaining what I call the hedge fund investors who's been buying up properties. And with those two reasons alone, our investment are not slow and steady. And why I use the word slow and steady is because she said that she wanted to grow her 250 slow and steady to $2 million. And I said it created for a sophisticated investor and who wants to maximize and capitalize on the small window of opportunity, much as we do. Our investment comes in two folds. First, deed of trust, being the first lien holder. For this, we typically pay our investor market returns on Project Glenwood, which we have a commitment from another investor, and another one is a gap funding, aka second deed of trust, being the second lien holder, just like a bank, charging you slightly higher percentage on your home equity line of credit, typically prime plus the percentage. We do the same and pay our investor higher on our gap funding program. And then I actually explained this as the easiest way to explain our tiered investment, our tiered investment, as number one being the blue chip company with lower returns, lower risk, and number two being a small cap with higher returns and slightly higher risk, right? And I go on, it says, because of this, my recommendation is to diversify. Leverage both your capital and credit, meaning use your capital for capital growth and aggressively grow it while you have market forces on your side, that small window of opportunity. Then being to hold on to cash flow, apartment, commercial building, and so forth. Many other investors will start with us as a gap funder so that we can show them a return, and then we'll recommend them to buy to build equity in rental commercial buildings, right? Because we do that with our investors and so forth. Otherwise, I just don't see how mathematically you can hit a consistent return of 20% return in 11 years. So that's me just being straight honest. And I went to say, I'm not sure if this type of answer you're looking for, but I hope it helped in connecting the dots. Give me a call if you have any specific question. So this particular investor was already telling me that, hey, you know what, that they're interested in investing with us, but I went back, and because her financial goals was not in line with the real market world, I had to go back and educate her. Why? Because I had a moral obligation, right? Versus some other investors I've heard and have actually listened to on calls is that they will flat out say, absolutely, we can go ahead and help you reach those dreams, and we'll go ahead and do that for you. And they'll go ahead and take the capital all day long, right? With false expectation on the private money investors. So it goes back to 2013, right? Your New Year resolution shouldn't be some type of resolution to say, hey, you know what? These are things that I don't like in my business, things I don't like in my life, I don't like in what I'm doing in my business, so forth. It should be focused on your actual clients, right? So if you're looking to grow your real estate investment business, focus on your clients. So focus on your private capital investor, making sure that your goals are in line, because you have a moral obligation to protect their capital and preserve their capital so that way they can grow it. And on top of that, you have a moral obligation, if you're working with cash buyers and you're wholesaling, to protect them so that way they can make a return when they buy a wholesale property to go ahead and flip it out. So 2013 within our organization is going to be actually focusing more on our clients, focusing more on our investors, to making sure that they can go ahead and help our business grow. But in return, we're going to protect and look out for their best interests, so that way we can grow together and achieve the financial goals that we're all looking to hit. So 2013 is going to be an amazing year, in my opinion. A lot of changes, especially in the real estate community, right? I made a webinar several months ago on regards to the big shift, right? The big shift in Wall Street that has come in and how it has distorted the market. It has been going on in other places of the country, but Wall Street has officially hit greater Los Angeles County, and they are buying up a storm. It's crazy stuff here. So if you haven't seen it, this is my plug-in, my shameless plug to check out the actual webinar. It's over 2 hours long, so great content, great information. So click on the button somewhere on the screen, and I'm going to end it here because it's 17 minutes, and I'm not even sure if YouTube will actually allow me to upload this video. And on top of that, I'll leave with this. Lakers, you got to All-Star season to, put your together and making sure that you can go ahead and win a championship, okay? So Dwight Howard, do something and knock down a free throw, please. Jeff Koga, and I'm signing out. And Happy New Year's.